Hey, everybody. Thank you for joining us. It is toward the end of first quarter earnings season, and we've heard from some of our favorite companies, some good, some bad. Um, Today, we're going to talk about Opendoor's results. Before we do, please take a minute, check out the link you see on your screen, fool.com/Frankel. Get the top 10 stocks to buy right now from the Motley Fool. It's the best way to support this work we're doing on YouTube. Again, that is fool.com/Frankel. So, Tyler's joining me. Tyler, I don't really think I'm revealing anything here. You're not the biggest bull on iBuying in general. Yeah, it's a tough business. Um, but
No, it's a challenging low margin business that hasn't really proven to be a profitable business model yet. So no, I know I'm kind of giving it away awfully early in the video, but I've been pretty skeptical of this for a little while.
well, we're going to debate a little bit. But you're right. If the iBuying business works, you're talking about like a 2 or 3% net margin. That's it working well. So the kind of thing I'm struggling with is that Opendoor is doing a good job lately. Um, you know, their business essentially imploded with the real estate market in 2022. What they call their old book of business and their new book of business. Essentially, when they say their new book of business, they're referring to anything that they bought after in July 2022 or later. That's when they say that the housing market kind of reset. In other words, they started paying realistic valuations for homes. Is kind of the nice way to say that. So in the first quarter, their acquisition volume roughly doubled year over year, but that was it's a tough comp. It's an intentional slowdown in 2023. They acquired about 3,450 homes. At the end of the quarter, they had another 2,600 or so under contract, and they're planning on ramping up pretty quickly. Their guidance calls for 4,500 acquisitions in the second quarter. Their sales volume was a little under 3,100 homes, so they're building their balance sheet. They're building their inventory right now. Um, and the numbers look pretty strong. Their gross margin was just under 10% for the quarter, which, like you said, low margin business. A gross margin of 10% is could be profitable if they do this business well. A 4.8% contribution margin. They still have some of that old book of business. Contribution margin, by the way, it's not quite net margin, but if you take your gross margin and factor things like the interest costs of carrying the home on your balance sheet and things like that, that's what contribution margin is referring to. The best contribution margin is coming from the homes that they did buy after that market reset. Their long-term target is 5 to 7% on the contribution margin. If it got closer to 7%, that's when you're going to see bottom line profitability. In the quarter, they lost money. Not a terrible surprise. On an adjusted EBITDA basis, they lost $50 million. The good news that is better than the high end of their guidance range. That contribution margin I mentioned was also above the high end of their guidance range, and they're seeing stabilization in the market is kind of the key takeaway. iBuying, and Tyler, you can jump in here, but iBuying, in my mind, is a business that's designed to work when the market is either stable or rising. If the market is doing poorly, that's when you see this business do badly. And when you're talking about houses and thousands of homes on your balance sheet, it can implode pretty quickly. So, Tyler, what are your thoughts on the numbers I just said and just the business in general?
Yeah. So for the negativity that I kind of started off with, I do want to give credit to new CEO Carrie Wheeler, who took over late last year, because she has been basically, in my opinion, kind of cleaning up Eric, the founder's mess, which he kind of left behind. There was a grow at all costs sort of strategy under the former CEO, and as a result, like you said, part of me doesn't want to put as much blame on, oh, it's the market, when basically management came out and said, look, our pricing algorithms stunk and we overpaid for a lot of homes. So I think it's a little, it's giving management a little too much credit to be like, oh, it was just the market, right? Because if you had a well priced, system that you're actually offering competitive prices for your homes when you actually sell them, because you shouldn't be paying like over market price if the convenience you're giving them is you can close really quickly, they don't have to worry about all of like the realty fees and all that other stuff. They should be paying for the convenience, and that was not the case. It appears recently that that is the case because, like you said, gross profit margins are rising. The contribution margin for 4.5%. That's decent. Like you said, it still needs to get higher. We're still talking about a business with if we actually use GAAP numbers and try to really hold management's feet to the fire here, we're talking about a net income margin of negative 5.65%. So, there's still a ways to go. And when you have a low margin business like this, like how much more margin do you think that we're going to gain from here on the gross profit and the net margin side to actually, get to a 2 or 3% net profit margin, and how much sales volume you're actually going to have to hit to do that? That to me is a pretty large march to get to that position. Now, if they can achieve it, obviously, a 1 point the business is valued at $1.6 billion. It's kind of technically trading for, uh, you know, less than the value of the homes on it. I mean, obviously, there's some debt that carries with that too, but if you squint hard enough, you can kind of see some value. But again, like it there's part of me that starts to wonder, like, what is the upper bound of profitability, and is that upper bound of profitability make it worth it for you as the investor to do this? And that's where I start to get a little hung up. All the credit in the world to the management who are trying to make the best effort at this, and I don't think there's a lot of people that could do it better than what they're doing right now. But the economics of this business are just so hard that it's going to be a monumental task for them to do it, and take very competent management, because you know we just went through a period of less competent management and we saw what happened.
Yeah, and to your point on management, I feel like new management is treating iBuying like it should be treated. In other words, they're treating it as a niche product. Whereas old management was treating it as growth at all costs. This is going to be the primary way we buy and sell houses. And that might eventually be true in 30 years. We might not have real estate agents or anything. But in today's market, this is a niche product. It's for people who need to move quickly. It's in, and are willing to take a price hit because of it. Because the whole concept is they're going to buy a home, do some cosmetic repairs, and be able to sell it at enough of a premium where they make money. You can't buy a house at market value, do some cosmetic work to it, and sell it at market value and make any kind of good margin. And that's kind of how they were treating it before. And now they're not. Now they're doing it correctly. But I do have some questions. Are they ramping back up too quickly? I mentioned they're planning to jump from 3,400 to 4,500 acquisitions sequentially. Some of that's seasonality. The real estate market's picking up, but are they ramping back up too quickly? Um, what happens if interest rates stay higher for longer and the market starts to decline? Not a great business when the real estate market's declining. It looked great when homes were rising by 20% year over year, and they could just make money just by riding the market value. And then there's the NAR settlement that raises some question marks. Um, on one hand, right now, Opendoor pays buyers agents to show their homes and things like that, and find buyers, and so they'll save money that way. But on the other hand, I'm afraid it could cause a lot of fee pressure, because right now people don't realize when you get an offer from Opendoor, they're going to take 5 to 7% as a selling commission, just like when you sell through a realtor. If Opendoor offers $400,000 to buy your home, you're not getting a check for that. You're going to have a fee deducted from that. That's a pretty substantial fee. So I'm worried that the NAR settlement could put their fees under pressure more than the market thinks. So I do have some unanswered questions. I'm getting closer to really liking this company than I was a year ago. I'm not rushing out to buy shares today, but I'm getting closer. If they can execute for another few quarters and get that, continue to narrow that adjusted EBITDA loss, because it is manageable at this point, if they're growing and ramping successfully. So I don't know. I'm more sold on this business than Tyler is, but I'm still not ready to dive in head first.
I'll tell you what. We can come back and I will change my mind and look really hard at a potential investment when I see a earnings per share that's positive. I think that's a fair,
We,
a
we,
reasonable,
they've done
reasonable
that
bet.
before. They've done that before, but you need to see a positive earnings per share in a normal real estate market. They did it in 2021 when the market was just rising by 10% every few months.
My
Um,
dog could have run a business in 2021 and made money in the real estate business.
right, I could have just like thrown darts at the real estate listings in a newspaper, bought those homes, held them for 6 months, and sold them and made money. Like it would, so it, if they can get positive earnings in a normal real estate market, by normal I mean stable, then it would do a lot to convince me as well. I want to thank The Motley Fool for sponsoring this video. The Motley Fool is a company that provides investing insight and stock recommendations for investors of all skill sets and risk levels. You all know how much I love researching new stocks and trying to find the next best investment, so I'm proud to partner with The Motley Fool to bring you 10 stock picks from their popular product, Stock Advisor. Stock Advisor has beaten the market by more than 4 times, so go to fool.com/Frankel to get your 10 stock picks now. The Motley Fool Stock Advisor returns are 650% as of April 16th, 2024, and are measured against the S&P 500 returns of 148% as of April 16th, 2024.